The stock market had a tough start to the week because the tech leaders got hammered. The Nasdaq was down sharply, and the hot IPO in SpaceX lost hundreds of billions of dollars in market cap in just a few days. Now, this begs the obvious question: is this the start of something really bad, or just another healthy round of profit taking before the next leg higher? Based on my greater than 40 years of investing experience, I definitely have some thoughts on this matter that I will share in this video. Plus, I'm detailing my second half of 2026 stock market outlook. I'm going to walk you through what I see as two very different paths the market could take from here, what each one of them means for your portfolio, and most importantly, how to best position yourself for each scenario. Stick with me through the end because I'll share some immediate actions you can take today to prepare, so let's get into it. By the way, I'm Steve Reitmeister. I've been investing for over 40 years, and almost half of that time as editor-in-chief of Sachs.com. And now I'm a partner at WallStreetZen.com, where I help develop the quant rating system and manage the Zen Investor Stock Picking newsletter. Over the decades, I've learned a lot about locating high-quality stocks. I'm happy to share some of those insights with you today. And if you like breakdowns on timely market catalysts like this, then please give this video a like. It helps me out a lot. Much appreciated. Okay, enough of all that. Let's get into the topic at hand about the stock market outlook and the recent developments for tech stocks. Sometimes you have to rewind just a little bit before you can move forward. So here's a mini recap of the year so far. The first half of 2026 can be put into three distinct phases. Phase number one, bullish start to the year, all is well with the world. Phase two, war with Iran begins. Oil prices spike, inflation fears spike, recession fears spike, and down goes the stock market. Phase three, peace still in the air and the bull market rages to new highs. But do we actually have a peace deal happening? I mean, Iran just reclosed the Strait of Hormuz this past weekend, citing Israeli actions in Lebanon as a violation of the deal. And U.S. Central Command says that the shipping is still moving normally, so there's conflicting information. The deal is probably going to happen, but I would not expect smooth sailing on that front. That's the basic backdrop that takes us into this past week. Then out of seemingly nowhere, tech stocks get knocked in the teeth, bringing down the S&P 500 and the Nasdaq. But here's something worth paying attention to. The Dow is actually slightly positive in that stretch because defensive names, we're talking about the Walmarts, J&J, Procter & Gamble, are moving higher. That divergence is definitely worth noting. When considering the situation, here's the phrase I keep coming back to because it has safely guided me through a lot of turbulent markets over the years. It's a bull market till proven otherwise. I know that sounds almost too simple, but it's actually more powerful than it sounds, and here's why. Bear markets are generally hard to create. The U.S. economy is far more resilient than most people truly appreciate. Yet the media loves the idea the fear sells, and thus make it seem like a bear market is prowling around every corner. Rarely true. Okay. Following that philosophy was my saving grace in the spring of 2025 when tariff fears pushed us to the brink of bear market territory. Staying true to the bull market till proven otherwise mantra had me buying that dip and appreciating the full benefit of the bounce. Now compare that to so many that ran for cover and cash and missed out on some extraordinary gains. As we turn our attention to the second half of 2026, I see the tale of two markets. I'm going to walk you through both of these scenarios with a trading plan for each to be on the right side of the market action. Now, the other day I talked about this plan in great detail during my weekly live training session. The focus is giving timely market insight plus top picks. I invite you to join my next one this coming Monday at 7 p.m. Eastern Time. It's free. Just sign up at wallstreetzen.com/live. Back to the tale of two markets. The first possible path is what I call the crazy train, as in the market becomes irrationally hyper-focused on AI stocks. You could say this is the second coming of the dot-com bubble of the late 1990s that ended with a bang in March of 2000, with many high-flying tech stocks falling 70 to 90% from their peaks. This is where serious FOMO kicks in, and AI stocks become an easy button for investors. The more they go up as all the energy gets sucked into this concentrated trade. Then investors start saying silly things like, valuations don't matter, or this time is different, or to the moon, and so on, right? The easy takeaway is these stock bubbles end badly because in the end, this time is not different, and valuations most certainly do matter, which lead to painful, life-changing losses. That is all true, but the real lesson from history is that as the bubble forms, it actually pays to participate in these stocks on the way up. For example, most valuation measures for the dot-com stocks were sounding alarms in early 1998. But the party didn't end for another 2 years, so you might as well play along and snag those outsized gains. But here is the real key. Use trailing stops of about 15 to 20% from the highs to lock in profits before they evaporate. Again, remembering from the dot-com bubble, it ended poorly with 70 to 90% losses for those stocks. Don't let that happen to your portfolio. Use those trailing stops. Now, the crazy train is just one possible outcome. Now, there were signs of that forming in 2025. You could really see that in the Mag 7, and we've had periods of that in 2026, like the unwarranted fervor over SpaceX. Now, forgive me, but there is no way that SpaceX should be worth more than Amazon when the latter has over $90 billion in profits and SpaceX is burning money, losing over $20 billion in the past year. That is the very definition of the crazy train. Now, let's contemplate the other path that I will call the rational rotation. This is actually the more constructive path, and honestly, recent market action gives me some hope that that is where we are heading. We are nearly 4 years into this bull market, and typically at this stage of the game, the usual suspect stocks are pretty fully valued. This is very true as we look across large caps and mega cap valuations. Now, this should beg investors to be on the hunt for value to unearth more outperformance. This chart shows you exactly where it's at. The mega caps are the pink line well above the historical norm for PE valuations for stocks, and thus should underperform going forward. The large caps are in red. They are on the high end of history, but not as scary as their mega cap friends. The value is to be found in small and mid caps, the blue and green lines. It's abundantly clear. Not just lower than their larger friends, but below the long-term averages. Value seekers should concentrate their activity here. Now, I want to be clear about something. I'm not predicting that large caps are going to crash. I think they're just going to be underperformers from here. The easy money in that trade is already in hand. What I think happens instead is that more money rotates into small and mid caps as investors rationally seek better value. That rotation has actually started. Year to date, mid caps and small caps have been leading the broader market, while mega caps have been the clear underperformers. That's not an accident. That's investors acting rationally and moving their money accordingly. To sum it up, small and mid caps, that's where I think the best risk reward sits for the second half of the year and actually moving into 2027 and beyond. In fact, they would have to rise 35% from their current level to catch up with their large cap peers, and that is just the average small and mid cap. You should never be satisfied with the average stocks. Your goal should be to own the best stocks. That is exactly what you get with our Zen Ratings Quant model that analyzes every stock by 115 unique fundamental factors. Only the top 5% earn our coveted A rating, and history shows they outperform the average stock by nearly 3 to 1. The Zen Ratings is available to you 24/7 on WallStreetZen.com, so be sure to bookmark it now for frequent future visits. All right, by the way, if you're liking this video so far, then now would be a good time to subscribe and hit that notification bell. That's the best way to ensure you see the next videos I release. To finalize the conversation on the tale of two markets, I think the rational path is the most likely, and that is how I am positioning my portfolio. Yet I'm prepared to switch gears to the crazy train if AI stocks become the only game in town. Now, in reality, there is actually a third scenario that we need to talk about. It's the one that could upend the market for a while, leading to a massive correction. And yes, if it goes on long enough, it could potentially usher in the next bear market. It's all about Iran and what that means for energy prices, inflation, and recession risk, meaning what happens if this peace deal falls apart. How many times have we heard about the peace deal and then hits a snag? On again, off again, on, off, on, off. Okay, so right now the market is betting the peace deal is on. And that's why we've made new highs with likely more upside on the way. Yes, that is the most likely scenario, but the chances of things turning ugly are well above zero. The longer there is no peace deal, the higher energy prices go, the greater the inflationary pressure, the more likely the Fed raises rates, and 75% of the time the Fed does that, a recession and bear market follows. Yes, bull market till proven otherwise is the phrase that pays, but investors who are pretending there is no downside scenario right now are not paying close enough attention. So what do you actually do with all this information? I think investors should stay bullish for now, but sleep with one eye open in case things turn sour with Iran. I'm not talking about a week or two hiccup towards signing a deal. I'm talking about things truly falling apart, leading to an escalation of the war and all the negative consequences that come with it. There is no need for you to sleep with one eye open. Consider that my job. meaning that I constantly watch the market action and share the latest timely insights and trading recommendations on my weekly live training sessions every Monday. Your goal should be to join me every Monday at 7 p.m. Eastern Time going forward so we can actively stay on top of this ever-changing situation. This is also where I share my trade of the week based on the proven Zen Ratings Quant model and my greater than 40 years of investing experience. These sessions are free, but you do need to register to reserve a spot. So do that now at wallstreetzen.com/live, or use the QR code on your screen, or use the link in the description. Use whichever suits you, but whatever it takes, I look forward to seeing you on Monday. Okay, now I'm turning the crystal ball over to you. What's your prediction on what happens next for the market? Crazy train or rational rotation? Or do you see another outcome? Please share it all in the comments section below. And if you want to hear more about the small cap rotation I'm calling out, then be sure to check out my video that's exactly on that topic. It's showing up on your screen right now.